You're watching Personal Finance with Coach Kelvin. Let's get into the video.
Hey guys, Coach Kelvin here. Today I want to talk to you about diversification and why it's a really good thing in your portfolio, but it may not be a really good thing for particular businesses in the money and the distribution of their products and services if it means that their focus on what really works with their clients and the services they provide is distributed too wide or stretched too thin. So we're going to talk about how it can protect you in times of volatility when you own diversified portfolios and how it can stabilize the long-term returns of your portfolio. But we're also going to talk about the detriment of it for individual businesses. All right, so when we look at a portfolio with, say, ETFs, listed investment companies, real estate investment trusts, and potentially even other asset classes like physical real estate, cryptocurrencies, and anything else like that, you're going to have a lot of movements in the market which affect the capital price at the time. So when we're looking to get capital returned to us, we want appreciation in that price or cash payouts through dividends or share buybacks. Now, when there's a underperforming asset class and you hold the entire stock market through a ETF, an index fund, listed investment company, etc., that one sector that's struggling is going to be propped up or supported by the other assets or the other industries and sectors which are performing well still. So if we look at, say, the VAS Vanguard Australian 300 index, this holds financials, it holds resources, it holds industrials, it has a lot of different sectors that sort of balance out the volatility in the whole market's returns. So if we, for example, have a drop in the production of mining companies, the iron ore price comes down, or gold is no longer able to be produced so efficiently, etc. Or, for example, when a tax is imposed on these mining companies, reducing their profitability, that may be propped up by how well banks and real estate and other sectors are performing. So even though one part of your portfolio will drop in price, it's not going to affect the entire portfolio because you have other holdings that do not move as much in price. If we, however, had all of our investments into one company that was only in the resources sector, we would see a much bigger drop in the value of our portfolio. And who knows, people may not actually be able to stomach such volatility. So having a diversified portfolio will, one, help you sleep at night so that you don't get freaked out and want to sell out of the market during any volatile times. Two, it will also help you to still maintain some capital if you had another investment opportunity come up and you needed to sell and put that money elsewhere. And three, if you had any emergencies come up, you don't have to sell when your entire portfolio is down because of that one sector exposure you had. Having many diversified income streams and holdings within your portfolio, whether that be crypto, real estate, shares, peer-to-peer lending, anything else, you can just simply sell the one that's performing best at the time if you needed to, so you don't take such a big loss in order to pay for that, say, medical emergency or new car that you needed or any other things that sort of pop up that life is unpredictable with. So, a diversified portfolio can not only help you sleep at night, it can make sure your cash flow stays fairly consistent depending on what the market does in particular sectors. Obviously, the whole market can have a correction and the price will come down, but often those dividend-paying shares and ETFs will be fairly stable throughout. If you have real estate, that can be affected by one tenant ruining your property, or you can't get a tenant for a little while, or perhaps there's a natural disaster which damages that property and you have to repair it. So we don't want all of our eggs tied up into that one basket with just one physical property, because as soon as something goes wrong with that, you really feel the blunt of it and you still have that liability through the mortgage if the property is not paid off. Therefore, you're going to be bleeding money, not just simply retaining what money you have. So if you want to own real estate, I highly recommend also owning other asset classes which produce cash flow, which you are not leveraged in owning. So if you have a mortgage against the property that you rent out, perhaps also have some shares that you've bought outright which have good cash flow that you can then divert the cash flow into that property if, for example, you needed to do repairs, etc. Peer-to-peer lending is also another fairly stable source of income. It's fixed. If you lend out, say, $1,000 for 5 years at a rate of 6%, you're going to earn that $60 every year in interest, and as that money is paid back to you, you can reinvest it or divert it elsewhere. That is up to you. So we want to have consistent cash flow plays in our diversified portfolio, as well as some capital appreciation through shares, property, etc. Now, when particular companies look at diversifying broadly, this can actually negatively impact them, okay? So let's look at, say, a company like Bunnings here in Australia. Bunnings offers basically a lot of materials for building construction, a lot of trades sort of things, and they allow anyone to go and do DIY projects, do-it-yourself projects at home. They sell all the tools, all the equipment, materials, etc. that you could possibly need, and even run workshops to help you do that. You can do your kitchen renovations, your landscaping, you can paint your house, everything like that. Now, if Bunnings wanted to change their type of business, and let's say they started selling cars, for Bunnings to actually put cars into their warehouses, that's going to take up some of the space from other areas in their facilities and their warehouses, meaning there's going to be less materials, less real estate within that warehouse to present these items that are actually quite profitable and creating good cash flow for them. When you have a car sitting in your warehouse waiting to be sold, it is an unproductive asset because the whole time it's there, you're still paying insurance, you're still paying to keep it having registration so that it can legally drive on the roads, and therefore it is a liability to hold. If you are affecting your possible overheads because you're supplying less products, or you have a less diversified type of material or something within your business, then another business could come along, not offer the cars sale within the warehouse, and potentially store other products and services that people want in a warehouse, and they might steal business that way or take some market share. So it would be a silly play, in my opinion, for Bunnings to stock and sell cars when they do the materials, the DIY projects, and the renovation materials so well. It would make sense, however, if they started also stocking perhaps something that could improve the services they already provided. So, for example, if Bunnings is looking to help builders build houses, and therefore they need to transport those materials, Bunnings could lease trailers out so that the contractors or the builders can borrow that trailer to transport the materials they buy to the site. And this is something they actually do. So they may keep 5 to 10 trailers on site, but not a warehouse full of cars and trucks, okay? And I hope that makes sense. We don't want to negatively affect the ability of a business to produce cash flow by stretching its attention too thin and dividing up your resources in a way that actually hinders growth. Every time a Bunnings opens, they sign up a really long-term lease on a warehouse, so they have to be efficient in how they actually store their materials. They have to really think about how to best use that real estate in the shelving and the displays to create the best cash flow for the business. And historically, Bunnings has been a very good hold. If you own Wesfarmers shares or any REITs that hold Bunnings warehouses, you're going to have generally very good returns because they increase their rents indexed to inflation plus 1% most of the time. They have very high cash flow because builders and tradies and contractors need materials at the flick of a button or the click of a finger to do a job on the day. It's not like a purchase and wait a few months for it to arrive. That doesn't work in this industry, so it's very important to have these physical retail outlets. Bunnings is more important than, say, a Myer or a Target in having clothes, which you could just simply purchase online and have it sent to you, because most of the time people don't need to pick up clothes on the day that they are going to use them. If you knew you had a party coming up and you needed to purchase a suit, you could order it online and have it delivered in time so that you could then wear that suit to your party. I hope that makes sense. So when we look at a business diversifying themselves and stretching too thin, it can be negative. Yet some businesses do this very well. If we look at Amazon, for example, Amazon have many sectors of their business. So they have their software as a subscription sort of service with Amazon Web Services. They also offer Amazon Prime, which allows faster delivery or priority delivery. They have their streaming service involved in that. They have Audible for audiobooks, which you pay $14.95 a month US, I believe. Then they have other services involved in that through the selling and buying of services, or selling and buying of products on their website. So this means if I want to purchase, say, I don't know, a new wallet, I can go on Amazon and search leather wallets and buy that. Someone else has listed their wallet on Amazon, I buy it, and it gets sent to me by Amazon. So they have many sectors within their business that all sort of work as this ecosystem that runs very efficiently. There's no real part of the Amazon ecosystem that is very much inefficient or losing too much money, because it all works together. However, if they had any sort of division in their business that really lost money, like let's say Amazon Prime was no longer affordable or efficient, they would likely either increase costs because they have so many people now in that ecosystem, it would be too expensive for them to switch out of it, and they could probably get away with that cost increase. Or they may look at adjusting that service in a way that becomes more profitable. Now, there is a book called the 80-20 Principle, and it's basically saying that 20% of your services or your products or your customers account for 80% of the income. And if most businesses can funnel most of their attention or can really prioritize their energy into this 20% of services and products, you're going to dramatically increase the profitability of their business and its runnings. So diversification in a business, while it can be good, it can also be detrimental. It's like it's an interesting balance to get right, because you may think, that this is the correct way to go, and it may be for a little while, and then you realize your business is bleeding money and it's actually not so viable. So a good example of this is when the Woolworths Group actually opened Masters hardware stores here in Australia. They ran for probably close to a decade. They realized that was actually the least profitable part of their business, because people could just price match with Bunnings and get their 10% discount. Therefore, Woolworths completely stopped providing Masters home wares and Home Depots, and then Bunnings actually reopened a lot of those facilities that were pre-existing as Masters, rebranded it, and Bunnings focused on doing what it does best, and Woolworths focused on doing what it does best, and that's with the groceries. So guys, I hope this makes a lot of sense. Diversification in your portfolio can be a lot safer because you're not going to have those huge fluctuations. You also may not get the huge gains that somebody who puts all their money into one stock can get, but you're also probably going to sleep at night a little bit more comfortably, knowing that your net worth will not go down, 70% in a day. This may happen, and it does happen. Now, I hope this is relatable, and there's probably a lot of instances where this has occurred also in the United States. For example, there are businesses that potentially take on other sectors, realize it doesn't work, so they cut it. Alright guys, thank you for watching this video. If you got any value from this, please like, share and subscribe, and I really look forward to seeing you in the next video.